Some industry analysts are screaming from the roof that the housing market would implode in 2022 or 2023 due to current market conditions. Is it true, or is it just more clickbait? Is now the ideal time to invest in real estate? Why not look no further than Warren Buffett if you need real estate advice? If you want to learn why Buffett has consistently advocated against investing in real estate, please sure to watch this video through to the very end. Real estate is not considered a commodity, unlike gold, oil, silver, etc. Due to the fact that it is a tangible item that is neither traded nor moved, its value does not change hourly. A robust, liquid global market does not exist for buildings or mortgages. The root of the issue is not oil, corn, or scrap metal. Commodities are identical. Gold or oil remains the same no matter where you are. There may be tiny variances, but they're usually comparable. Unlike real estate, where no two buildings are the same, and even residences in the same neighborhood might be completely different. Real estate is a difficult asset class to convey since, depending on the market you're discussing, values may behave extremely differently. It is well known that the property markets in Australia and Canada did not decrease as much during the past few years as the American market did. It is unclear whether these two source-rich nations are capable of preventing harm or are simply lagging behind their American counterparts. Real estate management involves purchasing and maintaining properties. Therefore, Buffett is aware that it is a company rather than an investment. Real estate is a very competitive industry. Scaling the firm to cover numerous properties is necessary in order to accumulate large riches. The majority of private investors sell their real estate holdings after realizing what they have gotten themselves into. Many buyers of real estate enter the market with the expectation that it will be a passive investment. Anyone who manages rental properties is aware of the difficulties it can provide. There will inevitably be problems, and tenants can be a real pain in the neck. Furthermore, when everything is taken into account, the financial benefit may not always be worthwhile. Leverage and appreciation are two ways to boost your results. Rent management is not always simple. You'll have to handle a variety of problems, including tenants. Over time, the buildings deteriorate and may even collapse. The 50 rule of thumb states that the actual return is far smaller and might even be negative. Then, with just one unlucky surprise, you may lose your entire year's earnings. A tenant could trash the property without paying the rent, or a pipe could burst. Either you may be sued or the roof might begin to leak. As a landlord, you face these difficulties on a regular basis. It's challenging for a company like Berkshire Hathaway to generate consistent profits, even on a large scale. For investing in real estate, there are different rules. By investing in passive real estate, investors can profit from this profitable asset class without having to take on management responsibilities. The FTSE REIT's Real Estate Investment Trust Index has outperformed the S&P 500 in terms of total returns in 13 of the last 20 years, with an average annual return of 13.1% as opposed to 11.1% for the S&P 500. The average returns on passive real estate investments made by many investors in the private sector have been far higher. The options open to passive investors include buying shares of short-term mortgage loans, investing in the equity of cash-flowing multifamily residences, contributing to financing of large-scale developments, or just buying managed funds. Even though the prospective return may not be as big, most investors have a far higher likelihood of long-term success when buying or developing real estate. Stick to your areas of strength. The clear definition and adherence to your area of competence are, in Warren Buffett's opinion, the most crucial requirements for investment success. It is crucial to concentrate on and establish yourself as an expert in a single or a small number of specific fields, since trying to do too many things at once makes it nearly difficult to be great in anything. Early investments by Buffett that were successful included companies like Geico and Dairy Queen, as well as consumer goods like Sea Candies, Coca-Cola, and Dairy Queen. Later, when the holding company of Berkshire Hathaway expanded, he widened his investment horizon and ended up investing in companies like IBM and Apple. Buffett, however, has mostly avoided industries that he is unfamiliar with. Sadly, he leaves real estate out of that list of enterprises. Charlie Munger, right-hand man to Warren Buffett, argues that we lack a competitive edge against seasoned real estate investors in a recent annual meeting. Since we lack expertise in the field and have a poor history with real estate, we don't give it much thought. Economically, REITs are substantially worse off. Buffett's holding firm Berkshire Hathaway is required to pay corporate income tax on its profits because it is a regular corporation. During the same annual meeting, Charlie Munger points out that, provided certain conditions are met, functioning as a firm like ours, which is subject to Chapter C of the Internal Revenue Code, results in an additional layer of corporate taxes being applied to real estate revenues. Real estate investment trusts, or REITs, that are publicly listed are exempt from paying corporation income taxes. Buffett adds that there are other sectors that are more desirable. Simply said, dealing with REITs as a C Corp puts you at a competitive disadvantage due to the current corporation tax rate of 21%, which would make Berkshire's predicament much worse as they would have to incur this additional cost. Could Buffett create a tax-advantaged entity outside of Berkshire? Yes, he could, but because managing Berkshire would likely be a far better use of his time given that that is not his area of expertise. Buffett appears to have previously supported REITs over rents. An analysis of prior annual reports reveals that Berkshire had owned assets in general growth properties that Brookfield eventually acquired. In addition, he has investments in Tanger Factory Outlet and Vornado's Seritage growth properties, but Store Capital may be his most well-known REIT purchase. The largest stakeholder as of 2017 was Berkshire, and in 2020 they raised their investment. Their initial investment is currently worth more than $1 billion. Consequently, why does Buffett prefer REITs to rentals? First, REIT is Buffett's preferred investment since it allows him to focus on his area of expertise and hand off rental property management to professionals. It is also significantly more tax efficient. Real estate investment trusts, REITs, have a stronger growth emphasis and primarily rely on tax-deferred appreciation for revenue. Third, REITs offer tempting possibilities to buy premium real estate at a lower price because they are more volatile than rentals.